Ask 10 statisticians how to calculate the standard deviation of, say, 50 data points, and you'll probably get a common answer. But ask 10 racehorse trainers how to optimally prepare a thoroughbred for the Kentucky Derby, and you might get 10 very different answers. So how about with 10 investment advisors? What if you asked them how to design the optimal portfolio? Would their answers suggest investing is more like statistics or science, as with chemistry, or more like an art, as with training horses, or masterfully smoking brisket, or a blend of all of these? And when you ask your financial advisors where their own investment philosophies and guiding principles came from, do you hear a coherent response? Or does it sound more like no such philosophy or principles exist? Today, in part one of a two-part episode, your co-hosts give the backstories about how they formed their investment philosophies, including what they once believed and now question, and what led them to that shift in their thinking. This discussion sets up their extension of these topics into next week's part two, when they'll explain in greater detail where that shift in their thinking finally led them, what they believe today, and why. Get ready also today to hear them critique the dominant portfolio design methodology of the last 5 decades, commonly called modern portfolio theory, and hear them discuss how the spread of readily available company data and inexpensive computing power has permanently changed the investment landscape and contributed to much sharper sell-offs, like the S&P 500's 35% drop in just 5 weeks in early 2020. If you like hearing people's intellectual journeys, stay tuned, because this may be the most autobiographic episode your hosts have recorded yet. Get ready for all that and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here, as always, with Adrian Nicholson and Erik Olson. Erik, how are you doing today?
I'm doing great. Thank you so much. How about you, fellas?
I'm doing good. Had a good weekend with some family and friends. Just been watching a lot of sports, but I'm a little bit worried about the gas lines to fill up my car. Have you been seeing this, Roshan or Erik?
I have not seen lines, but tell me tell me about it.
I'm just seeing people post on like social media saying like fill up your car now, waiting in a little bit of lines, and I feel like it's all my fault because on a few episodes ago we talked about inflation. I was like, the one thing I don't want to see is gasoline lines, and a few weeks later they're here. So I guess I kind of messed it up.
That. So that actually it touches on a couple of our episodes, the one on inflation and on cybersecurity, because it was a cybersecurity attack on that one, one fuel supply or the pipeline operator in the Southeast that led to this. So for all our listeners in the Southeast, man, we please send us a photo.
Oh yeah, yeah. Well, yeah, and I have. Adrian, when you say you've seen it on social media, have you seen lines in Virginia?
Yeah, I've seen no crazy lines, but I've just seen some people like sitting in line like late at night, and just people saying, "Oh, get it while you can." It's just like I'm seeing it like here and there, so now I know it's definitely a thing now. But like Erik said, we touched on it. It's a cybersecurity attack, and on the inflation episode, I was like, I just don't want to experience this in my life. Next thing you know, it's here, so. Just got to be ready for it, I guess.
You jinxed the entire country.
I did, Erik.
Yes.
I have that power, apparently.
Well, now I'm supposed to go drive up to New Jersey this weekend. I hope I don't get stuck up there if I can't get gas to come back home.
I bet all the people with electric vehicles are just laughing at us right now.
Yeah. Yes. Oh man, I have not. I hope we don't get those lines. I've read about the lines in the 70s, right? So that's what I'm worried about now. Hopefully, it's just internet hype. Another version of GameStop.
Well, so I'm a little older than you guys, so I have sat in those lines, and they are absolutely no fun. So I'm not eager for that at all.
Yeah, hopefully it doesn't happen. So, gentlemen, today we've got an interesting episode. Adrian, do you want to introduce it?
Yeah, of course, Roshan. We got another exciting episode kind of centered around investments today. We're going to kind of talk about our investment approach, our methodology, and how we kind of got there. I think it's going to be a really exciting topic for our listeners today to kind of get a deep look at our practice and how we've kind of implemented our investment approaches over time, how we kind of fine-tune them, and overall our like theme and how we came to. I think it's going to be really good because if you look online, there are just a broad range of different like investment practices, strategies that people implement. Some you've never heard of before, some more common than others, but we're just going to kind of tackle our approach today just to kind of get the listeners to see a little bit of overview how we implement it. Do either one of you want to start off today with a little bit of an intro on how you came to your kind of investment practice?
Well,
Roshan,
I'll start with, I'll add something. Yeah, I'll add something to that. And I'll tell you, I feel like I've been looking for investment methodology that makes sense from before I started in the industry, back when I was in school and studying investing. And what I've learned over time is there are a lot of different ways people can successfully make money through investing, and that you've got to find what resonates with you. Right. And what I mean by that is, I always talk about how Warren Buffett's one of the my favorites, and one of the greatest investors of all time. And he's considered a value investor, which means he's looking for undervalued securities. But at the same time, he's said many times you can't have value without growth, right? You need a growing company. And interestingly enough, his firm Berkshire Hathaway was a undervalued company that essentially was dying, right? So you could argue that was actually initially purchasing that firm. What that company wasn't a great move, but what he's done from it has been phenomenal. So that's just an example of value investing. Now, when I started in the industry, everything was about modern portfolio theory, which is supposed to be the most efficient way to invest when you consider risk and return. And that's where I started, and it sort of evolved over time. So when I started working with clients, to simplify it, as I like to do, it's really the split of your portfolio between stocks and bonds and the various categories beneath them, subcategories of stocks and bonds, to make sure your portfolio is efficient. That's where I started, and over time I became less of a fan of it. To me, it seemed like it just didn't work for multiple reasons of that we'll get into. But that's where I started. Was you get this portfolio of funds. Back then, it was mainly mutual funds, just because ETFs weren't really out yet. But mutual funds of stocks and bonds, and then you rebalance the portfolio, usually anywhere from 12 to 24 months, and that was kind of it. That's where I started. Now, I found that I didn't think it actually worked effectively, so I've shifted from there. But Erik, let me ask you, how did you start out when you first started investing, either professionally? Is probably the way I'd start.
Yeah, well, I had been in a role as a trader rather than as I would say an investment advisor. So I was personally designing based on math and statistics, methods of short-term trades that would have a probabilistic edge in producing a profit on that trade. And so when I made the shift from that approach, a statistical approach, into as a trader and as a trading systems designer, into being an investment advisor and a financial planner, I recognized I needed to make a change, because it was not going to work either in the framework of the relationship with clients that I had, or within the compliance structure in which I was operating, to sit there and just make trades, statistically based trades for clients all the time. So at that point, as you just indicated, Roshan, the dominant way of thinking, or really the only way of thinking that had been introduced to me, was, as you pointed out, modern portfolio theory, the view that with a bit of math, stemming back to some Nobel Prize winning work that was done by some economists at the University of Chicago in the early 50s, that with that bit of math, you should be able to identify the optimal mix of different building blocks for a portfolio, some large US, some large foreign international, some small US, some small international emerging markets, bonds of various kinds, etc. Insofar as each of those asset classes, we call them, has a track record of how it has behaved in the past, behavior measured in terms of how much it's grown, how wildly it swings, how much it swings in tandem with or in opposition to other candidates for inclusion in that portfolio. Knowing all of that about the track record that they've established should allow you to say, well, if there's broad consistency in the behavior of these kinds of asset classes in the future with what we've seen in the past, then this would be a good mix that balances limiting some of the swings, but at the same time getting decent growth. And so I accepted that. But over time, my thinking has shifted.
Now, Erik, what and I can answer this first if you'd like, but was there
Please.
something specifically that any specific event, time period, or anything like that that had you realize that this wasn't right for you, or your practice or your clients?
Oh, I think it was probably that seminal moment that affected so many advisors who came into this career in the early 2000s. And that was after the internet bubble had burst and people saw the hazards of highly concentrated portfolios. In those days, the highly concentrated portfolios in the lead up to the internet bubble bursting was tremendous overweight on tech stocks. In the aftermath, people of that got gospel and said they need to diversify. But even the diversifiers, myself included, during that downturn in 2008 credit crisis, learned that in the worst of times, those supposed advantages of diversification all disappear, because pretty much all of the asset classes, with one or two exceptions, gold and US Treasuries, all the asset classes correlated in their behaviors. There wasn't really, at that moment at least, a good diversifier. And so I realized, we have diversification in the good and moderately good times. We don't have genuine diversification in the worst of times. What's the solution here? How about you?
My time frame for my thought process was actually pretty similar, but I got to it in a different way. So, Erik, what you had just described of in 2000, the bottom in 2009, but really started in October 2007, was just that no matter what you owned in the public space, you were losing money. And I don't know if you remember back then, but there were very popular real estate investments back then that also lost money because it was a real estate bubble. So not only were your public investments losing, but a major component of the private investments also weren't a savior for you at that time. It's interesting when you compare that to I was just listening to a book about the five market crashes, and they talk about how a lot of these crashes in the past had components that were where they needed liquidity, specifically Black Monday with portfolio insurance. And that liquidity is gone when things are going down. You don't have that level of liquidity. I think you have a similar impact on diversification, but I'm going to take that a step further and just mention during that time frame, I had a client that retired a little bit after the tech bubble in 2000. And this always sticks out to me because between 2000 and 2010, there were the average modern portfolio theory portfolio didn't make anything, right? Because you had the markets crashed, and then they recovered by 2010. Which, if you look at it just from a market perspective and the timing, a lot of that it wasn't great, but it wasn't terrible. But at the same time, if you're someone who's retired, and someone's retiring, in this case the client was 70, we were planning enough till age 100, so we were planning 30 years for the rest of their life, and they lost a third of their retirement life to no gains in their portfolio, which has a devastating impact on their retirement. Right. When we're building this financial plan and we're using these assumptions as far as growth goes, we need the growth, right? Most people need that growth to be able to retire. If you have a third of your retirement with no growth, it's devastating. So that was where I saw both what I call it was real world data, but what I'll call pure finance, like the harder side of finance where we talk about the numbers and the data. But I also had a corresponding softer side where you look at just the impact on someone's real life, and that to me was very telling that this is just not going to work effectively for what I do. And by this, I mean telling people to put all their money into modern portfolio theory. And then a very popular phrase in the investment world is specifically during that 2007 to 9 timeframe was buy and hope instead of buy and hold. Right. So that's kind of what I felt like then. We were using modern portfolio theory, and they had funds. We would buy those funds. We would make adjustments and rebalance, but to a certain degree, we would buy and hope. And it just had to work out. So I think now I had been researching things along the way, but what's also difficult for what we do as advisors is certain things you aren't able to execute on. Right. And it's not like I had a lot of things I couldn't execute on, but I'm thinking particularly I had to change clearing firms about 3 or 4 years ago, which is a very time consuming. You lose a quarter to 6 months of your work just trying to do something like this. But I had to do that to be able to execute on some of these strategies I thought would lead to better performance. And they have. But my point is that at the beginning, I'd said there's a lot of ways you can invest your money, and you've got to figure out what works for you, what fits your portfolio, your comfort level, and there are also a lot of different ways where you have a good historical track record, right? So it's got to fit your comfort level, and you've got to have some evidence that performance is there. And I put it that way because you have the disclosures and disclaimers on everything that past performance is not a guarantee of future performance and so on. But you've got to put the odds in your favor, Eric. Kind of like you said with your trades, they showed a statistical edge of performance, not a guarantee, right? A statistical edge.
Right. It's probabilistic.
So, yes. So going back to what you had said, we both had a similar experience with modern portfolio theory where we used it, we were trained, we were taught, and it's still trained and taught today, quite frankly, as by a lot of firms is the way to go. Right. But then for similar reasons, we decided we needed to either adjust it or build on it. Where did you go from there when you saw that, okay, this does not do exactly what I'm looking for? What was your next step or next move?
In my case, it was, it took a bit. It took a bit from, I'd say roughly 2000. Well, the bottoming process of the credit crisis was, as you pointed out, in March of 2009. And initially, I guess I would say my concern was that the correction wasn't completed, and I expected that there would be a dead cat bounce coming out of the bottom of March of 2009, and that we would right up until about 2010 or middle of 2010 with the recovery that we had in that portion. I thought that was probably just presaging another big leg down, and we would put in new lows. And I thought that for a variety of reasons, but without necessarily going into why precisely I thought that, my posture at that point was then to look for some additional diversifiers that would in some ways mimic the lessons that I had learned as a trader, which included the ability to short. And so I was looking for things that weren't going to take over the portfolio, but they would be layered into these portfolios that would hedge against another big downturn. And of course, what I didn't understand was that with the Fed pouring money in at the pace that it was, there was not any realistic way in which those markets could go down. Really, truly, the lesson of don't fight the Fed, I think, is a very painfully learned one for me. So I took a very, very cautious posture for another, I would say, almost 2 years, thinking, we had the downturn in 2011, another downturn in 2012, and I was thinking, is this it? Have we just moved a little higher, and are we now ready for another leg down? But I realized, Erik, I think your beliefs are wrong. Or at least your understanding is incomplete. Your emotions are also a factor here. What can you do to appropriate some of the lessons of when you were a trader that defeated what I think is the chief enemy of most good investing, and for that matter, most good trading, which is emotionally overriding your method? And even if the method is modern portfolio theory, I hasten to add that. And by the way, I'll also hasten to add, and I think we should circle back to this later in this conversation, that I still do use a generous dose of modern portfolio theory in my approaches with clients. And the listener might be asking, why? You just denounced it, and now you're saying that you utilize it. And there is an explanation. It's not, I'm not schizophrenic on this topic. But so in any case, it was in the middle of 2012 that I said, what are some of the lessons that I can appropriate from that period as a trader that worked so well that that could in fact be a solution here in an investing framework rather than a trading framework? And we can talk about those. But how about
that's great, Erik. And drawing on those lessons is really great. Just using that experience, using those different market environments that you're in to kind of build your framework going forward, I think is really important, because there are going to be times where your investment strategy or your practice, whatever it may be, is in favor and it's doing really well. And then there's going to be those times in certain market environments where it's going to have those pullbacks and not do as well. So just kind of having that built-in flexibility where you can make some changes, as long as they're not emotional changes, is good. So you can develop an investment practice or strategy over time that's built on past experiences, I think is really good. Just always adapting, because the markets are always changing, technology is always changing. So having that built-in flexibility while also drawing on lessons and what happened in the past is a really good way to look at it.
Yeah, and Erik, actually, before you even mentioned how you were you use modern portfolio theory, because I use a modified version as well, and I believe yours has modifications that you've added to it. Is that correct? Also,
I would say it's been augmented so that there's a portion that's modern portfolio theory when the other approaches aren't working, but simple buying and holding is.
Well, I'm before you even mentioned that, and by the way, I use a modified version as well for a portion of assets also. I was going to say, in that decline that happened between 2007 and 2009, modern portfolio theory did outperform the broad markets, right? But the question I had at the time, and I still feel strongly about today, is I just thought it wasn't good enough, right? Like it did, the markets crashed, And I don't expect modern portfolio theory to lead to people making money. The flaw that I saw at the time, similar to what you pointed out, is that when you break modern portfolio theory down, it's all about diversification, right? When one thing goes up, something else is going down, and when something else goes down, something else is going up, and it makes the ride smoother. The problem I saw at the time was with modern portfolio theory, how the flaw was everything went down. Right. There was no place to escape except cash at the time. So that's where I thought, and Erik and I have had these discussions at length before. For everyone listening, we're both nerds in the finance space. But what you and I have discussed before is mathematically it's sound, right? You can't necessarily argue the math behind it, but I found there were a couple issues that don't work for real individuals with it. One is the time frame. The data set is so large, and people, unless they've got endowment level assets, if you're investing for your retirement and your financial plan says you've got enough till age 100, well, you don't have an unlimited time frame, so these shorter term movements have a greater impact. Right. So that was one issue of it. The other issue I found with the long data set, and I saw this during the crash of the crash that happened in 2009, is that when I was comparing bonds at the time and I was looking at mortgage-backed securities, which had been absolutely crushed, and the modern portfolio theory software I was using was saying, well, you can go for don't waste your time with the mortgage-backed securities, because you can do treasuries and you'll have a similar outcome. And what I found was the error was in the data set being so large that you miss the opportunity for what could be you miss what could be short-term opportunities. Right, over 100 years, that 40% crash in mortgage bonds kind of smooths out over 100 years, but it creates a really good opportunity to invest at the time. So that was my issues with it. So I started off saying there were positives to it. One, once again, it did better than just investing straight in stocks, so you were protected to a certain degree. But I thought the flaws were the data set is so large that it just can't help individuals as much as it should.
I think yeah. No, I think actually as we're having this conversation, it strikes me that we maybe ought to have an episode that's just a deep dive on really deconstructing and then reconstructing modern portfolio theory. By the way, I at least from my vantage point, I am not trying to make this an assault on modern portfolio theory or any sort of an attempt to make a wholesale denouncement of it and dismiss it as a useful component. And as we've indicated by our previous indications that we still use it, I just think it's useful to understand the premises on which it's constructed, and then if those premises are flawed from time to time, they are, then so that you're not taken by surprise. And which I think early in my own career in this role, I was somewhat taken by surprise. You did say one thing, Roshan, which was that modern portfolio theory worked to a certain extent, and I would agree with that. During that downturn, a 60-40 portfolio was less damaged than was an all stock portfolio. You could certainly say that. And as it recovered, it didn't recover as swiftly, but it didn't have as much ground to make up. And so for quite some time, coming out of that, for someone who owned that 60-40 portfolio, 60% stocks, folks, 40% bonds is what we mean by that 60-40. For someone who owned that versus, let's say, owned just the S&P 500, then it took probably until I'd say at least 2013 before you saw the 100% stock ownership strategy outperform the 60-40. It took a long time for that to happen. So at least, but I do think that looking at this closely might be worth another episode at some point. Yes. The thing that I would say, maybe ever so slightly differently than you said, Roshan, is that the data sets, I think you referenced the long histories of the behaviors of these different building blocks, again, what we call asset classes, sometimes masks how in certain short bursts they can behave dramatically differently from what their long-term relationships are. And so part of the problem here, it seems to me, is that the art part of modern portfolio theory, it's billed as essentially a science, but there is indeed an art, because it's predicated, as we said earlier, on how things have done, how much they've grown in the past, how volatile they are in the past, and how correlated they are with other asset classes in the past. Here's one example of the art. How far should you look back to reach those determinations? And once you see that the things have moved out of phase with one another in ways that aren't characteristic, or that their historic records wouldn't have led you to believe that they would behave quite that way right now, how swiftly can you recalibrate the inputs into your modern portfolio theory model to reassess what the expected returns should be? So, for example, in the S&P 500, when it hit bottom in March of 2009, while its volatility could probably be known and its correlations could be broadly known over a long period of time, is its historic return now, which is lower than it was 18 months ago by virtue of it having a 50% drop, is its historic return now the best guide to how it will behave going forward? Actually, what you probably should do is, precisely because it has had this 50% drop in this phase, our expectations about its forward return now should be more generous. And so recalibrating in accordance with the actual recent moves of these different asset classes, I think, is a part that it makes a big difference. And that's where the art comes in, is how does a group that's charged, or who makes it their business to arrive at these expectations, how do they go about that? That's where their art comes in, because they certainly do not all agree.
Eric, you bring up a very good point here that I want to talk about too, from a value investor's perspective. And I believe Buffett's spoken on this, but it may not be him. But multiple people have. When you're constructing a portfolio using modern portfolio theory, volatility is one of the inputs. I'm sorry, standard deviation, is one of the inputs, right? So a stock that has, like you mentioned earlier, if something has dropped by 50%, that's a huge standard deviation, and modern portfolio theory would limit your exposure to it because it has that huge standard deviation.
Right.
Whereas a value investor is saying, well, if you thought the stock was a good deal at $100 and now it's worth 50, it's an even better deal. Right. So that's one of the criticisms of it, is that, are you actually using the standard deviation or volatility as you should? Now, the argument against the criticism there, though, is in order for you to have the mathematics work, you've got to have uniform sets of data, right? And so you've got to use standard deviation, because there is no better alternative. And as you mentioned already, I'm not criticizing the theory itself. What I am saying is, in my experience, I'm not comfortable as an investor and in advising people to put their money exclusively in this one strategy, especially in its purest form, just because I've lived through eras like 2000, 2009, and even last year in 2020, where it did not provide as much protection as I would like, right? Just using the pure theory. So that's
interesting, Roshan. And I have kind of a question, since we are talking a lot about like data and research. It's for either you or Eric. Have you ever felt sometimes the data, like in your practice over time, has gotten in the way of maybe like a decision making, where there have been there's all these big data sets out. There's been all these big market events. There's just so much out there, and just weeding through all the data and just looking at all this research, has it sometimes been like a challenge to kind of just look at all this information, like new information that's constantly coming out, where let's just take it back like 20, 40 years ago, where they didn't have as much information as we have to make a decision, to kind of like formulate or maybe adjust your investment approach over time? Because I know you two are very big into data, looking at the research, doing the analysis, and it seems like doing more data, doing more research, doing more analysis can help you make a better investment decision. But sometimes you can do all the data, it can line up perfectly, but it tends to just be the opposite. How did you kind of like work around that, or how do you like move forward with that and like implement it in your approach?
How about you, Roshan? How would you answer that?
I would say, so the short answer is probably, but being a data person, I don't have data to back up that assessment. And it does remind me though of there's a famous value fund that did a study of their own investments in their own portfolios, and they tried to gauge whether their additional research beyond just the ratios actually had an impact, and the impact was very minimal. And they went back and looked at their performance and their holdings back to like the 70s, I believe. So what they found was, if they just bought based on the pure ratios without doing the additional research, and the pure ratios take up 2% of the time, and 98% roughly, right, is on the additional research, that it didn't really have a significant difference in their performance overall. So that would be an argument against the data. But I'll actually answer your question a little differently. What the data does is, I think it helps you feel more comfortable making a decision, and sometimes that could lead to maybe overconfidence or underconfidence in a decision. And for example, I'll go back to what Erik had said earlier about when the Fed was pumping up the markets back in 2009 and on, right? And that he was looking and concerned that there would be another leg down. All the data suggested there would be, right? I remember reading multiple reports and white papers from economic institutes that they labeled this as a credit crisis, or they use the term a belt tightening market crash. And every other time in history there was another recession, and that other recession every other time in history was within, if I remember the data correctly, it was either within 3 or 4 years. Right. So the expectation was there will be another recession that will lead to another decline. And that's what all the data was suggesting. And looking back, we all know now, well, that data was wrong. We also know why it was wrong, or at least we believe it's because of all the money the Fed pumped in and the low interest rates. But that's just an example of your question on the data, where that's a case where if you ignored the data and you just looked and said everything's going straight up, you would have done better than being in the data. Although I don't know how comfortable you would have felt, right, going into that. It felt too risky at the time.
Yeah. So, Adrian, I think if I thought I understood your question to be asking, number one is, how has our reliance on data, insofar as it's continuously evolving, how has that been a benefit or a harm to us? Was that part of the initial part of your question?
That's the first part. Like you said, like now people are implementing algorithms into their investment strategy. It's just like technology is progressing further, so it seems like you have like a broad range of areas to choose from now, compared to how it used to be, where it's just combing through it all.
Well, so I will acknowledge that I think that's an astute. First of all, I think that's an astute question, and if we trace what's taking place in the popularity of certain approaches to investment over the last century or so, you see precisely that. As new information and new technology for considering that information became available, people adapted to both the computing capability as well as the emergence of that information and shifted the way that they invested. Prior to Graham Dodd in the 20s and 30s and their introduction of an approach, I think the title of their book was Security Analysis. Most investments were made, at least as I understand the history, by a good story being told about an interesting company that seemed like, a good bet to where you could put money. And with the introduction of security analysis, they showed no, it was possible to if you were rigorous about the data that you collected on the companies of interest and then compared those data about them, in their case primarily related to their value and how, that is to say, how much you'd have to pay in order to buy a certain amount of profitability in that business, or a certain amount of sales in that business, or a certain amount of free cash flow in that business. They revolutionized that process. And then when in the early 50s, modern portfolio theory and the computing power that came with it that would allow you to measure these other attributes of asset classes, then that changed again. And more recently, to your point, once the desktop computer was introduced in the mid 80s, and suddenly it became possible for little investment shops. They didn't need a supercomputer. They didn't need a Cray. They didn't need to be at a research institute. They could, in their own, spare bedroom or their, little office space, begin to do certain amounts of programming and analysis and so forth. That made it possible for many people to see things that they had never been able to see or measure or to make decisions upon before. And as that has advanced and computing power has advanced and the evolution of data has advanced, as you pointed out, Adrian, more and more people have turned from a qualitative approach to investing to a quantitative approach to investing. Much of the movement in the markets today is, I don't mean literally on this date as we're recording, but I mean in our time, much of the movement of the markets that seems at times to be a herd mentality and extremely swift moves, like the move that we saw in response in early 2000 to the recognition that, wait, maybe this coronavirus is a bigger deal than we've all been understanding it to be. How do you get a 35% decline in the market so swiftly, the fastest such decline of its kind? It's a lot of that has to do with algorithmic trading, where these computers have been programmed based on a set of rules that were derived from a set of data and analysis on that data to sell at the instant that they see certain conditions triggering it have been satisfied. And boom, then if they sell and they begin to sell. And if that happens simultaneously because everybody has used the same data and has arrived at roughly the same conclusions and has, on the basis of those relatively same conclusions, programmed their computers to adhere to essentially the same rules, what you see are these very rapid movements, particularly to the downside, because the selling impulse is it seems as there are more agreement on that than there is on the buying impulse. It's the place of data and computing power has, I think, permanently altered the landscape for investors.
Yeah, that's a great point, Eric. I mean, it's just been kind of in the back of my mind recently as I developed my own methodology, and just how important technology is becoming and advancing over time, kind of how that relationship's kind of going to go hand in hand with my own practice in the future, just developing my own investment methodology and incorporating the relationship that technology is going to play in. And I know it's just going to be something I'm just going to have to review annually at this point, just the way how things are progressing. It's just something that I'm just going to constantly be just looking into.
Yeah. Well, you have, I'm excited for you, Adrian, because I mean, you have, depending on how long you want to persist in this career, but 40 or 50 years to see what Roshan has only 30 years and I have maybe 10 or 15 to see. So it's like, it's great. I'm excited for you.
Yeah, and
Yeah, I
Adrian,
am too.
I would say I am noticing our timing, and I'm thinking maybe it makes sense for us to pause and then return to this next week and sort of keep our, like the episodes of Batman in the 60s where they'd have this dramatic interruption and then they'd have to continue next week. I'm really interested to hear what, not only how you got to this place, but what informs your thinking about investing now, and we can share with our listeners that. What do you think?
Yeah, well, I want to add one more thing, and then I agree with you. We'll continue. So today we've talked primarily about modern portfolio theory, and probably ended up bashing it more than we intended to. But I want to close the modern portfolio theory conversation by asking you, what modifications have you made to the portion of the portfolio you use for modern portfolio theory?
So I think I've approached it differently than you, Roshan. So what I've done is I've offered to clients the opportunity to augment modern portfolio theory with a variety of other approaches, and some of those are what we can maybe detail next time.
Get into next
what
time.
I'll say
Okay.
are factor-based approaches, and then some of those are getting outside of the space of publicly traded securities and using private placements for accredited investors in particular, on both the equity and the debt side. That's been the main offering as an alternative to an exclusive approach to modern portfolio theory. I think yours is a little bit more systematic and uniformly applied to your client base based on than is mine, based on the earlier conversations we've had about this.
Oh, yeah, so it's the strategy, if used, is uniform, but for someone who's using it within their risk tolerance, but it's definitely not applied to everyone the same, just because of them personally, their thoughts, their risk profile, and so on. But so just one follow up, and then I'm going to answer my own question about modifications.
Okay,
so when someone is using modern portfolio theory with you, you're using the purely statistical data driven output and the various asset classes as indicated by the purest sense of modern portfolio theory. Is that correct?
I am, although
okay.
Even there, we should acknowledge there's art, because you have the option of constraining, and we can maybe talk about that next time, constraining the model to limit how much it can allocate to any single asset class, or conversely, you can say remove all the constraints, and if you just, even if it meant that you concentrated all of the assets into 3 or 4 asset classes, how heavily would you use those asset classes? So there is an art to a certain extent in the application of, or the absence of, those constraints. And then the second thing is which of the various capital market assumptions are you going to appropriate for use within that what we'll call, I will use a technical term here, it's known as mean variance optimization. That's the mathematical procedure behind modern portfolio theory. So, whose capital market assumptions do you appropriate into that, irrespective of your decisions about the constraint? So there is an art to that, I would say.
I completely agree. And even with using this theory in general, there is an art. Now, I approach it a little bit different from you, where I don't use it in its purest sense.
Okay.
I've created some modifications that I do first on the individual level with risk tolerance.
Okay.
I'll look at valuations and where we are in the business cycle. And I will then have a conversation with you with adjusting your risk tolerance. So, for example, if I think we're at an early stage where I'm expecting a boom, and Erik, you are a moderate investor, I'll have a conversation with you about, do you want to stay moderate, or do you want to slightly increase your exposure to stocks based on current market valuations? So that's one modification I'll make, because to me that addresses the length of the data and some of the issues where you've missed short-term opportunities, where I viewed it as such with modern portfolio theory. The other thing I'll do is I will actually focus more on asset classes that have lower statistical and to a certain degree negative correlation, so that we have so that what was missing for me in 2009 was that everything was going down and there was nowhere to hide, so to speak, is that now there is a place to hide. So it's not just the pure math, it's also making sure there's a negative correlation to a certain degree by each asset class. That's something that that I researched and learned along the way, but then I felt validated when I had read that Bridgewater and Ray Dalio's book. They have something similar there. So I thought, okay, well, the smart guys are doing something similar in there. So going back to Adrian, your question about the data and the statistics, and if it can be too much, well, that's a scenario where I feel like I've helped address what I thought was lacking. And then I was able to find something else that validated, but their data was a lot more robust than mine. I think I had looked back 20 years and they'd gone back much farther at Bridgewater. Adrian, one other thing you mentioned earlier that I just wanted to say when you were talking about developing your strategy is one thing that I find important, and I guess I'll use this to wrap it up unless either of you have anything to add. We started this conversation saying, as an investor, you've got to find what's right for you. I've used the term on here before where I say you've got to find out your investor personality. You know, what fits, what are you comfortable with? And I think very much our conversation today is about that journey, but everyone's journey will be a little bit different because it's got to be within your comfort zone as an investor. So finding that, and the other valuable point I think we have today is showing how it evolves, right? We started out at one place, and with our experience, it's slowly evolved. And some of that experience is looking at data, and a lot of that experience is also living through what's happened in the markets. So, gentlemen, today it's been... Oh, go ahead, Erik.
Yeah, I just want to say to our listeners, so you've probably heard the most autobiographical episode that we've done to date. So I'm fascinated because I don't know a lot of the things about your process and your story in this way, Roshan, and so I'm excited to learn more next week.
As am I. It's interesting that our timing overlaps and some of our decisions overlap, but how we got to them are very different. So I agree. Adrian, any closing thoughts on anything, modern portfolio theory, or anything for the listeners?
I've enjoyed our discussion today. Like Erik mentioned, it's kind of a good, deep look into how your practices develop over time. So I appreciate you sharing that today. It was great.
Yeah. And for the listeners, we will continue on this topic to tell you, we've touched on how we started with modern portfolio theory, how we've adjusted and evolved, or at least started to adjust and evolve from that. But we'll continue sharing information to where we've gotten. And we're providing all this, hoping it can help you in making better investment decisions yourself. Thank you very much for listening. We will have a lot more to come. And please subscribe, give us 5 stars, tell your friends and family about us. This has been another episode of the Retirement Lifestyle Show, and we'll be back to you next week.